Portfolio diversification is principally driven by correlation. And what we see in real assets is that the correlations to the two biggest portions of investors' portfolios are attractive. Most portfolios are comprised of equities and bonds. And real assets have correlations to equities of generally 0.8 on the high end to 0.4 on the low end. So those correlations can improve your overall portfolio diversification. Similarly, real asset correlations to fixed income are about half the correlations of equities. So 0.4 on the high end to 0.2 on the low end. So again, those low correlations to both equities and fixed income, which are the largest part of most portfolios, can drive improved diversification, lower risk, better performance. In addition to low correlation, you also want to get good returns. If you have uncorrelated assets with poor returns, that really isn't beneficial to your portfolio. Real assets have historically had low correlations to both equities and bonds, but also superior performance. Real asset equities, better than global equities. Real asset fixed income, better than traditional fixed income. So that combination of diversification and better performance can dramatically improve your portfolio. We think there's a lot of value in U.S. energy master limited partnerships that are known as MLPs. The yield on those investments are very high, approaching 7%. The cash flow growth rates we think are going to be strong and will continue to be strong. And the valuations are significantly lower than they were at the peak of the oil boom when oil was $100 a barrel. So we find that to be an attractive space. Similarly, we find residential mortgages to be attractive and high yield real asset debt to be attractive. Many people are concerned about rising interest rates, and in floating rate residential non-agency mortgages, we are insulated from that rising rate phenomenon because they are floating rate securities. High yield bonds, while they are fixed rate, they tend to move more with the equity market than with interest rates because high yield bonds are credit sensitive. So they're economically sensitive. And what you find is that when interest rates rise, if the economy is getting better, the credit spread actually narrows so that high yield bonds can perform pretty well in a rising rate environment. Active management can be very beneficial in the real asset spaces. For example, if you look at REIT portfolio managers, roughly 75% of REIT portfolio managers outperform their benchmark. That is a far higher percentage than managers who are active in a more broad space like the S&P 500. I do think the specialized nature of the assets, the inefficiency therein, does allow focused REIT managers to outperform their benchmark. Similar numbers and similar outperformance can be found in the listed infrastructure space as well. So beyond the ability of the security selection to drive excess performance, in a multi-asset portfolio, asset allocation can also add performance. We run multi-asset portfolios where we allocate capital to different investment teams at Brookfield. If the portfolio manager responsible for asset allocation can actually predict which asset classes will do better and increase allocations to those spaces, and predict which asset classes will do worse and reduce allocations to those spaces, you can drive a second level of outperformance. In a multi-asset portfolio, you can achieve two levels of excess performance. Number one, security selection within the asset class, and number two, asset allocation excess performance across the asset classes.